What's going on? So today I want to look at a Fed speech that was given by Lael Brainerd. She's obviously on the board of governors. So this was given on May 16, 2019, at the National Tax Association's annual symposium. This is actually a very good speech because it talks about, and it's not that long. So I actually highlighted some important parts, like when it first came out, right? Uh, but it does talk about the disconnect between the labor markets and inflation outcomes in the economy. So basically, I'll give you a little bit of overview. So basically, what this whole speech is really talking about is basically that even though our economy has had, at least in 2019, right? Even though we had the lowest unemployment in over 50 years, we were still not able to get inflation, to go above or even at 2%, right? So the inflation was way below what the Federal Reserve needed it to be on a general basis. So I actually highlighted a couple of very good parts through this when this speech came out. It's an old speech, but it's still relevant and it's becoming more and more relevant. And this is actually becoming more relevant not only towards the lower end of the income spectrum, but it's becoming more and more relevant to the middle and even the higher end income spectrums, right? And so on this one, right? So I'll start basically page number 2. Uh, it's now the first part is stupid because anybody that knows anything about the Fed knows what it's designed for. But it's important to stress it because a lot of people, they have these weird theories and all this nonsense, right? But paragraph 2, Congress has assigned the Federal Reserve the job of using monetary policy to achieve maximum employment and price stability. Price stability means moderate and stable inflation, which the Federal Reserve has defined to be 2%, even though they have not been able to maintain or even achieve 2%, right? Maximum employment is understood as the highest level of employment consistent with price stability. So basically, and we'll get further in this page, you'll get to it, right? But basically, in the past, the way that the or the Federal Reserve was able to control unemployment and inflation or price stability was by basically either increasing unemployment or decreasing unemployment, right? Because in theory, it makes sense, right? Because it did make sense before. As more people are working, more people are making money, more people are spending money. And so inflation goes higher because what you have is you have more money chasing a limited number of goods. So that's inflation. So we'll go down to the bottom of the page and it says employment and inflation. Now you can read this, but what mattered to me is basically this is what I just said earlier. The job market is strong. A 3.6% unemployment rate is now lower than it was before the crisis, right? So we're talking about the 2008 crisis. However, the picture on so in contrast, right? So even though the number or the unemployment is at 3.6%, in contrast, the picture on inflation is puzzling this far into an expansion. Despite the strengthening of the labor market, the measure of core inflation, excluding volatile food and energy prices, did not move up to 2% on a sustained basis until last year. And in the most recent readings, the 12-month change has moved down to roughly about 1.6%, right? So now that is very puzzling, right? Because you have so many people working, and yet they're not chasing the goods, right? So they're not going out there and buying all the TVs. They're not going there and buying all the cars and all of that stuff, right? So that's what she's talking about on page number 2. Now we go down to the new normal, right? And so on this one, I'll actually read it. So it says this: the new normal. Since the Great Recession, there have been several changes in macroeconomic relationships, which I refer to as the new normal. Now is a good time to assess the characteristics of the new normal and what they mean for monetary policy. The emerging contours of today's new normal are defined by, this is very important, low sensitivity of inflation to change in labor market slack, a low long-term neutral rate of interest, and a low underlying trend inflation, right? And then on a side note, I put it will probably get worse. In today's new normal, price inflation has not moved up consistent with as the labor market has strengthened considerably over the course of the long expansion, right? And then I put a note here, it says money velocity is not rebounding, wealth concentration. So basically what you're having, right? Again, even though you have people working, they're still not chasing those goods, right? And that is because they're not able to chase those goods. Because number one, they are debt saturated, right? So they are burdened by massive amount of debt, college debts, mortgage debt, loan debt, car debt, and all that other kind of debts, right? And so that's why even though unemployment was at historic levels, right, low, inflation was also low and they couldn't do it. But it's also because there's another thing, and that we'll get into this paper, and that is because people's expectations of inflation was also low, which keeps inflation low. So we'll go to the next page, page number 3. It says the Phillips curve is very flat, right? So the unemployment rate is very low, and also inflation is very low. Where it's supposed to be different, it's supposed to be inverse. As the unemployment rate drops, inflation is supposed to go up. But in this case, it doesn't work, right? And then on yellow, it says, although wage growth has been moving progressively higher as labor market slack has diminished, broader price inflation has remained muted. On the note, I put must raise inflation expectations, somehow debt growth outpacing wage growth, right? And that's important because that basically it it stops and it chokes the economy. And then another important feature of today's new normal is that the long run neutral interest rate seems to be lower than it was historically. The neutral rate of interest refers to the level of the federal funds rate that would maintain the economy at full employment and 2% inflation if no tailwinds or headwinds were buffeting the economy. The decline in the neutral rate likely reflects a variety of forces globally, such as the aging population in many large economies, somehow slowing no, okay. Some slowing in the rate of productivity growth and increases in the demand for safe assets. So this is basically talking about, right? So the neutral rate. So the neutral rate is that we're so basically what the neutral rate is simple. So wherever the people feel most comfortable at borrowing the money, right? Without the Federal Reserve either helping the economy or basically restricting the economy, right? So that could be a 2%, that could be a 3%, that could be a 5%, it could be a 1%, right? Now that rate, that neutral rate that's invisible, right? It's a lagging rate. That rate is affected dramatically by the level of debt in a economy, and it's also affected dramatically by the age of the population, because older people don't necessarily take on a lot of debt. Young people take on debt because they will be able to pay it in the future, but older people won't. However, neutral rates also drop down if the people believe that the future holds uncertainty, right? Because most people won't take on debt, most people won't buy if they believe that the economy will shrink or if they have a very negative outlook on the economy. But if the people have a positive outlook on the economy, they will go borrow, they will go spend, and that will increase inflation. Again, inflation is simply an imbalance between supply and demand, right? Uh, Higher demand than supply, prices go up to basically create that equilibrium. So that's very important. Then we'll go to the blue. It says the underlying trend inflation. The trend in inflation after filtering out our idiosyncratic and transitory factors appears to be somewhat below the Federal Reserve's goal of 2%. This raises the risk of household and businesses could come to expect inflation run persistently below the Federal Reserve's target and could change their behavior in a way that reinforces that expectation. Now remember, so this is very important, right? So inflation expectations, whatever you expect will become reality. So if people believe that in the future inflation is going to be much higher, people will purchase today to save money for tomorrow. But if people believe that the prices will remain the same or maybe even decrease, they will either buy only what they need or they will hold off on purchases because they think that the prices will drop. Now, that again, right, it will cause inflation to go down. Now, inflation is important to be up because as prices go up, wages go up and economic growth goes up. Without that, you won't have it. And I put this expectations are an important determinant of actual inflation because wage and price behavior by businesses and households is partly based on expectations of future inflation. And I put good luck with that because back then there was no chance in hell that the Federal Reserve was going to get inflation up until the COVID-19 happened, obviously. And that kind of changed everything. Then we'll go in the past recessions, the Federal Reserve has typically cut interest rates by 4 to 5 percentage points. Now, on the previous video I made about the economy, I was talking about that in a healthy economy, right? You would want the interest rates to be at 5 to 6%, and the reason for that is right here. So, if there's a recession or if there's a downturn, the Federal Reserve can cut the interest rates far enough below the neutral rate to a point to where they would become stimulative, right? So they would actually be able to stimulate the economy. But because we don't live in a healthy economy at this point, right? They can't, and the Federal Reserve is having an extremely difficult time increasing that neutral interest rate. No matter what they try, it's not really working. That, of course, was what was happening during what you call happened following the financial crisis when the Federal Reserve kept interest rates close to zero from December 2008 to November 2015. Now, this was attempting to basically stimulate the economy, right? So after the crisis, the Federal Reserve dropped the rates almost to zero, right? Trying to stimulate the economy. But again, right? You're below the neutral interest rate, so you can't drop the rates far enough below your neutral rate or where the people feel comfortable to make people excited to go out and borrow money. So it didn't work, right? It's very difficult to work. That constraint limits the Federal Reserve's ability to provide stimulus through its conventional tools could and thus could tend to leave inflation lower than it would otherwise be and unemployment higher. The experience of several years with the federal funds rate pinned at its effective lower bound and, and actual inflation below our target could weigh on expectations for future inflations and thereby influence the behavior of households and businesses that helps determine wages and prices. The experience of sustained period of low inflation could depress underlying trend inflation by feeding into lower inflation expectations, further reducing nominal interest rates and the space to cut interest rates in what would become a downward spiral. Very dangerous.